Hi everyone. Um, Good evening, and glad that we all are here. And this is a second session today. Yesterday we had a good discussion around account aggregator and the technical specification. Uh, I will request you all to join our WhatsApp group if you want to interact with us, async, and any support in terms of you are facing any issue in terms of onboarding to the sandbox. So please reach out to us through the WhatsApp group. Uh, Today, masterclass, we have kept it on insurance and investment advisory. The first session will be taken by Colin Fernandes, who leads innovation at Max Life Insurance. Uh, all the master classes we have kept are considering the themes or where we want the teams to build product on and nothing better than Colin himself coming in, who is a user of Account Aggregator, and I think Max was one of the initial life insurance company who came onboarded on Account Aggregator. He will dwell upon what all innovation can happen, what are the current processes and challenges which insurance industry is facing right now, and with other data sets, with data democratization happening or with DPDP Act, how other data sets can be used to make insurance more personalized and customizable for the customers. Thought process is not just getting innovation, but eventually somehow we have to put in effort to make insurance affordable. You can also think of building some solution on frauds, how we can actually, because eventually all the premium cost which is being offered to the customer includes the loading of all the fraud cases which happens. So if there is some innovation you can bring in into fraud, we are also looking towards those solutions. So I'll not take much of the time. We'll have a 1 hour session with Colin, and then we'll move on to the another session, which is on investment advisory. So I'll welcome Colin. Colin, just give a brief introduction, and feel free to put your questions, and we'll happy to answer them. Uh, Over to you, Colin. Thank you.
Thank you, Abhishek. Thank you very much. Good evening, everybody, and very happy to be here with you all this evening. I represent Max Life Insurance, as in the capacity of I lead some of the innovation projects itself. One of the things that we were involved in as part of our innovation focus was the account aggregator ecosystem. So we've had the privilege to work closely with the entire Sehmati team as well as some of our TSP partners in getting account aggregator implemented at Max Life right from the inception. And we've seen this entire ecosystem grow and develop over the past 2 or 3 years. That's a bit about me. I think we have a lot to cover, given that it's insurance and it's not a very well understood industry, at least from the outside. So without any further ado, let me get on to what I have today. I'll take pauses in between. I'll open it up in case anyone has questions. Maybe after 2, 3 slides, we'll take a pause and see if there are any specific questions, and then we can move ahead. All right. So a brief agenda, what we'll cover today. First, we'll just focus a little bit on understanding insurance, given that many people may not be from the industry or might have a cursory understanding of the industry. We'll look at insurance in general, and since I represent life, we'll focus a little bit on life insurance. We'll then look at a bit of the AA ecosystem. I believe many of you have already attended yesterday's masterclass and are familiar with how a broad AA ecosystem works. But we'll just deep dive into this specific to insurance, and we'll show you how we have implemented 1 or 2 use cases at our end. Then we'll look at other possible use cases that we think are possible from the insurance perspective. And then we'll leave you with couple of opportunities and trends that we see as problem statements, which everybody in the insurance and specifically at Max Life we are trying to solve. So this will give you also a perspective of what is relevant to the business and what might help the business adopt whatever you develop. We'll first start with insurance in general. So typically when you say insurance, people understand it only as health. Some of them understand it as life. But Broadly, it can be categorized into four major categories, right? One is general, which covers health, property, motor, and travel. Then you have specifically health, right, which is a subset of general. Sometimes it is looked at separate. Then you have life, which only deals with death or disability. And then finally, you have special insurance, which is like parametric, micro insurance, etc. So understanding insurance, while insurance is a little complex, if I look at it as in a simple form, and look at it as a layman, it is basically protecting yourself from any risks due to an unpredictable future or a set of unpredictable events. Wherever there is an unpredictable event possible, you can put a form of insurance to play down the risk. We've even seen this on electronic devices, right? Where you don't know when a device uh, might malfunction, and hence you put an assurity on it saying that in case in the next 3, 4 years, 5 years, something goes wrong, we cover you. We call it warranty, we call it assurance, right? Essentially, it is a form of insurance. So don't when you hear insurance, always think of it that wherever there is unpredictability, there is always a possibility of protecting yourself from risk, and that will lead to different forms of insurance. So that is the basic concept of insurance. Let's do a little bit of a deep dive in terms of life insurance. Now, when I look at life insurance, again, you see many of these plans out there saying term plan, endowment, and so on and so forth. Essentially, life insurance, I'll just go back once you've understood this, right? So health insurance covers health, that in case you are unwell, something happens to you, but you are still alive. So either a disability or a medical emergency, you are covered by a health insurance. In general, all of you who own a bike will at least have an auto insurance with you, right? Which protects you from the damage of one, damage to the vehicle, damage to yourself, and damage to the person that is your third party, that is whoever you might meet an accident with. And in case a third party is also injured, then it covers them too. In life insurance, the way I understand it, when I came into the industry, is there are only three risks that all our products cover. First is the risk of dying young. So if there is a family or if there is somebody who is dependent on you, and you know that you are maybe, if not the sole earning member in the family, at least one of the primary earning members in the family, and if something happens to you at an early age, then the family might not have enough income, either because there are no more educated people in the family, or people in the other breadwinner doesn't earn so much, or you are a double income family, so on and so forth. So people protect themselves typically very early, saying that, if I die young, now what is defined as young, it depends from person to person. For me, young might mean up to 45. If I have kids early, it might mean up to 60. It could be even beyond 60. But essentially, what we say is that if somebody is feels that, okay, if I die young at a certain age, people who are dependent on me might be at risk of a sudden income stoppage, can protect themselves from this risk. Then I have the other problem on the other side, which is the risk of living too long. That is, if I continue to live for a long time, then I should have enough money to sustain me for the rest of my life, at least my current lifestyle for the rest of my life. And that is basically the next part, which is living too long. And in between this is the risk of not growing your money enough. Now, this risk of not growing your money enough also can be solved by other instruments such as fixed deposits, mutual funds, equity, debt, and so on, depending on your risk appetite. The only benefit is an insurance, okay, lies when you're looking at this risk, which is not growing your money enough. An insurance lies somewhere between an FD and an equity. It's closer towards an FD. The only benefit that a mutual fund gives, the only benefit that an insurance gives you is that it adds a tax benefit that you have over a fixed deposit. But many of these kind of plans are fixed in nature. So let's look at each of these plans and understand this simply. The first one, which is risk of dying young, is a simple term insurance. You would have heard this. Basically, it says it is low cost. I cover you for a certain specific period of time. You pay a small premium to me to so that I cover you for that risk. At the end of the period, you do not get your money back because I have charged you a very small premium. And for that premium that I've charged you, I've given you almost 10x the cover. So that is why you see a lot of people who take a term insurance, and this is the cheapest product that's available in the market. You can get, say, a 10,000 rupee premium per year. You can get almost a 1 to 1.5 crore coverage. The only thing is you do not get anything back. But those kind of products are designed to basically cover you of the risk of dying young. On the other side, you have things like annuities, which basically you start investing into this product at a certain time in life, typically around your early to mid 30s, and the money compounds and continues to grow. And once you reach a certain retirement age, you start receiving a monthly payout in the form of a salary. So even after 60, you continue to receive a fund flow which compensates you for the income that you has stopped because of your retirement. And in the middle of these, we have two kinds of products. One are endowment plans, which are nothing but what LIC used to be very famous for, that you pay X amount of money for some number of years. After X number of years, you get the money back and you get some form of compounding interest which is added to it. And you also get a life cover. But the life cover is not as much as what you get on term plans, it is far less. And another type of money compounder is a ULIP plan, is basically something which takes your money, but instead of putting it in fixed, safer instruments, puts it in the market, in the equity markets, and hence you take on a little more risk. But these are typically long-term products. They help you only if you hold it for a longer period of time because, like equity, like the nature of equity, it takes time for the product to start earning because it is linked to the market returns. So that's the basic fundamental of this of life insurance on how our products are structured. So if you have to understand it, remember this, that you will see many kind of products. Try to put it in these three buckets. You'll start understanding this better. Either it protects the risk of dying young, the risk of living too long, or it is growing your money. Growing your money, there are safe assets called endowment plans. There are riskier assets which give you higher returns called ULIPs, and that's how you can classify this. There is something under annuity which also I have mentioned called National Pension System, or the NPS. Now, this is important to also understand because this data is also available on the Account Aggregator framework. So the National Pension System is a compulsory pension scheme launched for the government employees and an optional pension scheme for private employees for you to save up for your retirement. The way it works is every year, you have a fixed tax benefit given under ATC, which you can invest into a pension scheme. At the age of 60, you have to purchase an annuity from the balance that is there. Okay. Let's not go, I think, on this session too technical about that uh, NPS as a product, but just understand this much, that National Pension System is a type of annuity product. It is a retirement, it comes under the retirement piece. It helps you save for retirement. At the age of 60, it is compulsory for you to purchase an annuity product from a life insurance company. So many insurance companies have their own pension fund manager, which comes under a separate regulator and works under the national pension system. That is why I've highlighted it separately, that even though it is a retirement product, there are subsidiary companies of life insurance companies which usually run and sell this product. I'll take a pause here to see if there are any questions on insurance and the business of insurance.
Any questions from anyone? Or we should move ahead. Colin, I don't see any questions in the Q&A.
Sure.
We can move ahead. Yeah.
Okay. So this I will just skip through. I think you would have seen these slides as part of your account aggregator onboarding. So obviously, where does the account aggregator fit in the entire India stack? That it is part of the data empowerment piece where you're looking at an ecosystem which allows you all the financial service players which are regulated under any of the uh, licensed regulators to easily share data with each other through this consented framework, right? That is how the account aggregator piece fits in. But it's important for you to understand this, because when you are building a solution, you will be using a lot of um, the other solutions in the other layers also. So consider that and see how that fits into to place. This is again a simple overview of how the account aggregator system works. One of the financial entities can be either a provider or a user of the data. The user requests the customer for consent to access some of the data with any of the other entities. Customer grants consent for a certain duration for a certain purpose. That consent goes to the provider. The provider verifies the consent, sends across the data. The account aggregator is data blind. They pass on the data to the user, and the user decrypts it and then uses it for its purpose. So this is a broad flow of the account aggregator ecosystem. Let's understand this a little better from the perspective of insurance. So one of the things that most of the insurers have already implemented is for financial underwriting. Now, let me explain a little bit for those who are not from the industry. What happens is, whenever you apply for an insurance, I need to check two things or three things rather on the application. One, is this the same person that is applying for the insurance? Is his identity the same? Is he the same person, right? If Colin is applying for insurance, is this Colin? The second thing I need to check is, does Colin have an insurable interest? That means, right at the beginning, I told you there are three forms of risk. So, does he qualify for an insurance? Let's say if nobody is dependent on me or my income in my family, and I'm applying for a 1 crore, 1.5 crore term insurance, the insurer can say, why does this guy need the insurance? There's nobody dependent. Given his age, given his current salary, I don't think there's anybody um, who's dependent on his salary. Second thing is, your income might be very low, but you're applying for a very high sum assured. So again, that raises questions. So the first thing that we check is, one, is this the same person and does he have an insurable interest to give him an insurance? The second thing that I check is, can he pay for the insurance, because the insurance is a longer duration insurance. The third thing I check is he healthy enough to actually actually pay for to take on the risk on my books. Now, what an insurance company does essentially here is, it will take your application, it will keep aside a certain amount of money for it's for the risk part of it, and the rest of the money it will look at putting into the markets and growing that, or a specific instrument and growing that money. Now, for to do that, I need to ensure that my claims are within a certain limit. And how can I ensure that my claims are within a certain limit? It is a game of probability, right? So I look at certain data and I take a call that, okay, what is the probability of this case coming for a claim or not coming for a claim? And to take those decisions, we look at this data, the financial proof and the medical proof. Basis that, you have an underwriting team which decides whether the case is good to go, or for the current risk profile of this customer, we need to charge him more instead of the current quote that is given. The second thing that you need to understand is what differs between health insurance and life insurance is, health insurance or general insurance like auto insurance, health, etc., have an underwriting or a new policy issued every year. So they can underwrite again, and hence they can reprice. So let's say today, at an age of, let's say, 30, I pay a premium of 5,000 for my health insurance. Now next year at 31, they can look at my medicals or my profile and my financial proof, and can decide that, okay, now he's crossed 30, so I need to reprice, and they reprice. So that's why you see your health insurance or your auto insurance every year, the number is different. But in life insurance, what happens is the number remains the same. So you sign a contract with me for a longer duration, that is 10 years, 20 years, 30 years, and so on. Now, and for that 30 years, I need to ensure that the premium that you pay remains the same. To ensure that the premium remains the same, I need to ensure that my checks and balances, that means both my financial check and my medical check is robust enough, because I will not get another opportunity to change this for the next 30 years. And hence, life insurance is a little more stringent in terms of medicals and stringent in terms of financial checks as compared to the other checks on the health side and the auto side. So that makes it a little more tedious to bring in innovations and to also get some of these things passed through. Now, with that understanding, let's understand this journey. Basically, a customer fills an online form. He does his KYC. Today, what he does is he has to upload a financial proof. He either physically submits that to a sales agent, or he downloads it from his bank, that is a bank statement or an ITR return or a salary slip and so on, and uploads it into the application. Then he has to schedule his medicals, go for a medicals. If everything is okay, it is approved by underwriting, then the journey is complete and the policy is issued. Sometimes the document that he submits here at the financial proof is not clear. Maybe he's asked to put last 3 months salary statement. We are today in October. He's supposed to put September, August, and July. He has put June, July, August, because when he started the process, it was September. By the time he submitted everything, the date changed, right? So the document becomes invalid. We don't have last 3 months. So in such cases, what happens is you go to the policy, the issuance remains pending. A further requirement is raised to the sales guy or to the customer saying, hey, I think we need last 3 months. You've sent us 3 months, which are not last three. So it comes as a pending financial requirement or a pending FR, if you see here. So to address this, account aggregator fits in beautifully, because as part of the journey, the customer goes, registers on the account aggregator, can directly send his bank statement, um, and the bank statement comes in directly from the respective bank where salary account is credited. Over and above that, there is an analytics layer which is built, which auto checks the salary statement, and it is called a smart salary statement. It looks at all your transactions, looks at what's your incoming salary. Is that salary consistent over the last 6 months? It looks at your expenses and sees what kind of expenses are you doing. It checks if there are any medical expenses which can indicate that a person's health is compromised. It checks for any other fraud-based transactions that are possible. And that auto check is then built into a score which goes to my underwriter, and he takes a decision. We have now even automated that to make it a straight-through process, that once you send a salary slip using account aggregator, I have a analytics engine which runs on it. It looks at the salary, the 6 months bank statement that has been shared, and it then decides to auto approve it if everything is clear. We've also done something using ITR here, and and I'll talk a little bit more. We can also look at GST as a source, which are all present on the account aggregator ecosystem. So I'll just show you how this journey works. So if you use or buy a product on using our online journey, when it comes to the account aggregator step, it'll ask you first to share your account using account aggregator. You put in your phone number. It'll ask you to proceed. It gives you an option to change your phone number also. The minute you put in your phone number, it discovers all your current banks linked to that number. You can select which bank accounts you want to go ahead with. It shows you within the bank accounts the different instruments, whether it's a fixed deposit or a savings account. You select whichever one you need to connect. Each account has to be verified by an OTP, that is each entity. So Axis Bank has to first verify whether this is the same customer. So you have an OTP check here. You have an OTP check for the second bank also. If they are authorized, it shows you what am I taking from you, that I am taking two savings accounts and one NPS account. How long is the data validity? That means I'm taking it for 2 years from so and so date to so and so date. And is it a one time access or a multiple time access? So we've taken every hour in this example, but of course we don't take it so frequently, but this is just an example. So the frequency of access, if the customer is okay, he gives permission and we get the data directly coming into our system. The analytic model works on the data on the JSON that's coming in directly, auto analyzes it, puts a score, takes a decision, and the case flows through in terms of financials. So that's how this entire piece works. So before I go ahead, I just wanted to check, are there any questions so far on what we've implemented? before we go into what are the opportunities that I can see?
No
Just
question.
okay.
We have got one. Here the insurance. If you see on the in the bottom Q&A section now, Colin,
Hmm.
you
Yeah.
will see all the questions which are asked. You just exit your PPT. Just
Okay.
insurance.
I think if there aren't too many, we will go back. I'll come back maybe towards the
Correct,
end and
correct.
take the
Okay,
questions.
we'll take the question
Okay,
that you.
done. So then let's look at the other aspect of insurance, which is insure. What are the other possibilities that are there in insurance that we can think of, right? So one is in this online form fill itself. Can I look at automated form fill, right? Since I'm getting most of the data from another financial entity, that financial entity has done some form of KYC and also filled and capture the same data from the customer which I use. His name, his date of birth, his gender, his address, his nomination. All these are similar data points which I can directly use. Now, of course, there are multiple. You can get it through other KYC. There are many other ways you can get it. But one of the thing is you can simplify the journey by asking for the financial proof much ahead in the journey and automate it and fill the form in the beginning itself, thereby reducing the number of steps. The other thing we could think of is I showed you earlier that sometimes if the financial proofs or medical proofs are not okay and we are not very happy with it, then there is an additional FR which is pending, right? A further requirement or a financial further requirement which gets raised. This mostly happens where you have an assisted sale where the salesperson has maybe not checked the document, etc., or he's given salary slips, the salary slips are incorrect, or he's given an ITR or a GST, which there is some issue with it. So you can use account aggregator to again close these pending FRs because the customer can immediately share these. These are huge friction points for us because they lead to pendency of the case from for a couple of days, and then the customer is also like, okay, I've sent you everything, you're still asking me for some more documents. This just eases the entire piece, right? This one we've already told you that I can convert the entire financial document that comes in. I can build an analytic model to auto score and auto take a decision of the financial document through a financial score. I can also put a one view of the customer depending on his other assets that he owns. Say, for example, his mutual funds, his FDs, his stocks. I can look at everything and see how does this customer look? What is his risk profile looking like? What is his appetite for different kind of products? How financially savvy is he based on what he owns? And I can take a decision and also understand the behavioral aspects of this customer. That can also help me, plan for the further part. Do I want to sell him something more in the future? How do I want to engage with him? How do I communicate with him? So on and so forth. So this one view of the customer is very, very useful. The second thing that we can use is on renewal. So let me explain this concept a little bit in terms of renewal. What happens is an insurance company looks at two things. One is at the beginning you pay me a premium, but I have given you a sum assured and a period of time where I'm saying that I will protect you for the risk of death on the assumption that you are going to pay me this premium every year. If you stop paying me this premium, it is a huge risk for me because I have written it as my future cash flows. And hence, I have to ensure that my policy remains persistent. That means my renewal continues to happen every year. So this is the concept of renewal or persistency. It is a very important metric in insurance. So I look at one, how much of new business that I'm getting and how much of my older business is coming back to me. These are two metrics that financial analysts constantly look at. And obviously it's used to calculate other things such as embedded value, etc., VNB and EVs and so on and so forth. But understand this, that two important things in insurance. One is getting new customers. Second is also retaining the existing customers. So there are a lot of scope here on the persistency part where I can check whether this person is, basis his transactions, the way he spends his money, etc. Is he going to renew my product? Does he have enough money to renew the product, and so on? And I can devise my renewal strategy also according to it. So these are some of the things that we could think of, and I have some more things that we'll talk about. Now I look at the rest of the insurance value chain, and there I divide it into, say, 5 major areas of use cases that I can think of. The first part is on the sales side, right? So let's say a salesperson is sitting in front of a customer. Today, what he does is he'll go to the customer and say, "Sir, can you tell me what else do you own? What are your goals? And how much have you saved up? How much do you have in FDs? How much do you have in mutual funds? Do you invest in stocks?" I can completely avoid doing all this using a smart advisory platform that I can build using the account aggregator framework. I understand where all he's invested. I understand gaps in his insurance. I understand gaps in whether, why has he invested into a certain asset? Does he have a goal, or he's just been missold these things? So a smart advisory platform is definitely useful for an agent. It helps smoothen the data collection, and it also helps in better advisory and product recommendation. The second is obviously product recommendation, looking at what he owns today and in what percentage does he own which asset. I can also build the right product to sell him. Does, again, I go back to my earlier slide of what is his need. Is it the risk of dying young, the risk of living too long, or the risk of his money not growing? I can make relevant product recommendations basis his entire portfolio analysis. The next part is, let's assume the customer has purchased a journey. Then where all can I use the account aggregator? I've already covered the first part, which is, auto form filling. The second is nominee management. Now I can take the same nominee that he is given at another financial entity and use the same nominee instead of asking him to re-enter some of these things again in that form. The third is the financial document fetch. Now, here, when you understand financial document fetch, there are certain perspectives that you need to understand a little more, because depending on what you are solving for, the instrument on the other side will be differing. For example, for salaried customers, I can just take the bank statement of a salary account, and that will do. This is the easiest to solve, which many insurers have already solved for using the account aggregator framework, where I take the bank account statement from a salary account, and that is sufficient for me as a financial proof. When it comes to non-salary, it becomes a little more difficult, because income sometimes varies, and I also want to check a little more details about the company. So in this case, so when I say non-salary, it means they are business owners, they are entrepreneurs who have their own business and so on. So GST becomes important, ITR becomes important. These two data, ITR, I think, is yet to come on the account aggregator framework, but it is work in progress. But GST is a document which is already available, and I think there are more forms which are being currently made available on the account aggregator framework. So these two documents can be used for non-salaried customers. Similar to new to credit or thin clients, people who don't have a large credit history, it's very similar to the lending industry. I can use a similar form of alternate underwriting for these people. And the fourth one, where is you have uneven income in the form of gig workers or freelancers, so on. Today, getting insurance for them becomes very difficult because they don't have a steady flow of income. However, if you share your entire financial portfolio, I can look at maybe your mutual fund holdings or other holdings and take a judgmental call saying, okay, this person has a fairly good savings rate, may not have sustainability of income every month, but I can still do some form of underwriting and take the case ahead. So you need to understand this part in terms of financial underwriting, that depending upon who is the customer, there might be the way to solve the problem through the account aggregator might be slightly different. Then we go to the next stage, which is post sale. So once I've made the sale, I need to check. Now, one of the important use cases that we think might be useful is the risk and fraud monitoring, where I look at his transaction statement on a monthly basis or every 6 months, and I see what is he purchasing. So two kinds of risk. One is the financial risk. Is there yeah, is there any problems on the source of the income? Is there money laundering going on, or something else that I notice which might raise a red flag? Or secondly, if I see a lot of medical expenses coming in, visits to the hospital, which would also raise a red flag, saying that is this for this person, or is it for somebody in the family? And how do I need to worry that there might be a medical illness which might result into a possible death, and so on and so forth. The second I already spoke about, which is renewal prediction. So I predict whether this person might renew, may not renew, depending upon his behavior, spend analysis, and so on. And the third one is, of course, renewal monitoring. Okay, if is he paying his money? Many people don't renew, or might be hard crunched for cash for some time. And I noticed that in the account before the renewal date, that okay, his account has zero money, but he's given a standing instructions of auto debit. Now, I know there is no money in that account. Why do I even run the auto debit? Can I reach out to the customer proactively and saying, hey, you've given me an auto debit. It's going to hit your account on so and so date, but there are no funds. Today, it's a blanket message which goes to everyone saying that please keep sufficient balance in your account. Right? Instead of doing that, I can actually target only those customers whose account actually doesn't have any money, and I need to ensure that when the ECS mandate hits or the auto debit hits, there is money in the account. Then I look on the claim side. On the claim side, typical thing is I need to verify whether this is the same nominee. So let's say um, person X has registered Y as his nominee. Now I can verify through the account aggregator, is Y the nominee for X in his other uh, financial instruments that he owns. So, for example, in two banks, I see Y's name as the nominee. In his mutual fund account, I also see Y as the nominee. Then I'm sure that, okay, this guy is a genuine nominee. He's the same guy who's coming in forth and claiming. And there are also no disputes because I see his name at multiple areas. So uh, I won't have somebody else coming and saying, oh, why did you pay it off to him? I have a will, and so on and so forth. The second thing I can do is I also need to verify the bank account of the nominee before I make the payment, that whether this account genuinely belongs to this person and there is nothing suspect in that account. So that is also possible through the account aggregator framework. The last part is on engagement and upsell. So obviously this is how do I engage with my customer, and this is, I think, an important area which many of you should look at. I have just put 4 things that I could think of, but there are multiple things here that you can think of how to engage with a person who's bought insurance. Unlike lending or a bank, which is which sells a lot of things and you keep an app on the phone, for me as insurance, I hardly get an opportunity for the customer to keep the app because he makes an insurance renewal payment once a year, and after that he doesn't need the app. So this is important for me to ensure that I give him some additional value adds. So what I can do is maybe I can give him a one view of his entire portfolio, and he monitors expenses, monitors savings rate, and monitors where all his money is. I can give him an expense analyzer. I can also make a insurance gap analyzer saying that, hey, you have these 3 kind of risks. You've protected yourself from dying too early, but your other 2 risks are non-protected. You don't have a health insurance. You should look at taking something like that. So this gap analyzer is also an interesting area to look at. Then you have NPS sales, where I told you about National Pension System, and NPS is also available on the account aggregator. So if I see that this person doesn't have an NPS account, I can always send them a nudge saying that invest in NPS. You save another additional 50,000 as part of your tax saving over and above the 1.5 lakh as part of ATC, right? And you also have another section which allows you to save an additional 10% of your basic. Um, and all this will go into your retirement. So NPS is also a good thing that I can cross sell. Just doing a double click on this, I'm just looking at the kind of data that comes in today across the different FIUs. As an FIU, what data I get from different FIPs, and what are possible use cases. Some of them I've already listed in the earlier slide. So let's look at deposits. I get data where I can use this data for form filling, right? I look at account summary. This can be used for transaction monitoring. It can be used for other reference checks and so on. I can look at spend analysis, expense analysis, savings analysis, risk, fraud, etc. We already covered that actually in the previous slide. When I look at insurance, I can see again similar. There are similar fields that come in terms of the profile. But when I look at what kind of a policy he has, what is the start date, what's the end date, I can check whether is for any risk or a insurance gap analysis and use it for cross sell or upsell opportunities. If I go a little further, I look at the other FIP data that comes in. So on mutual funds, I can look at, alternate underwriting. So if I see from his transactions, he has an SIP which goes, and he has a sizable amount of SIP which is going in. Even if he's a freelancer or a gig worker, I can still take some form of a calculated decision on the underwriting and decide to offer the policy. Similarly, for a self-employed or a thin client who doesn't have a credit history, many people don't take credit cards for the entire life. They don't own a credit card, right? So or they don't take any loans in their entire career. So there will be hardly any credit history available at a credit bureau, and I can use this data to take a judgmental call. Similarly, I can look at a risk appetite. I'll see what funds he owns, and I'll see how long has he held these funds, and I'll get a sense of the behavior of the customer. How risky is he? If he's only using passive investment options, then I'll figure out that, okay, this guy is fairly risk averse. While he is better than an FD customer, he's looking at equity. What percentage is equity versus debt? And within equity, what does he own? And I can take a call on on this persona, and understand what kind of products I need to recommend to him, or how do I need to advise him accordingly. NPS, I already covered that. NPS data is there. If I can check that he doesn't have an NPS, it is a straight NPS pitch that I can make. GST, this is useful for self-employed, where I analyze this. I haven't seen many people crack this as yet in the industry. This is still work in progress. A lot of insurers are still struggling to put this into a model. So this is a good opportunity for you to look at this GST data. Having gone through the entire account aggregator framework and used it now for the past 1.5 year, there are certain things that we have realized as benefits, challenges, right? And I'll go through them. The benefit that we've seen is that, one, the data is recent. So I don't have old data coming in. It is refreshed depending on when I'm looking at the data. The data is authentic because it's coming from another entity, another source directly to me. So I don't need to doubt this, and it saves me time on my scrutiny check. The data is coming to me directly in digital form. So I don't need to do this OCR and digitization of the data and all, which was a huge headache for us. That has slowly been eliminated as the data comes in directly. It also allows me to run a model in real time, right? And also look at dynamic pricing, also look at dynamic underwriting, because data is coming to me again in real time, and I don't need to digitize it again. So latency is low. Privacy is anyways inbuilt into it because of the consent architecture. It is convenient, no hassles of screenshots, uploads, downloads, and so on. So customers are slowly picking it up. On the online side, we've seen our uptakes going to around 40, 45, almost 50% customers now who purchase policies online through our website prefer to use the account aggregator. We are just rolling it out for our field team. We've just rolled it out 2 months back, but we are seeing the field also slowly believe in the power of the account aggregator and are pushing it through for people to use account aggregator to share the data, because the case gets approved faster. And I can also do cross validation of the data from multiple sources. So a person's name, etc., is it the same across his other entities or financial products that he owns? And then I can also do a risk mitigation there. In terms of challenges, there are some challenges which we still face while using the account aggregator, and you should keep this in mind while designing products or designing a solution for your hackathon. The first part is, because there are multiple OTPs as part of the design for every entity that you register on the account aggregator, I need multiple entities. This typically leads to drop-offs, because when I see too many OTPs coming in as a customer, I get a little suspicious that why is he asking me so much data, and why are so many OTPs? Is this natural? Is it not natural? I'm using it for the first time. So point one and point three are interlinked, that as part of your journey, please think of how do you build trust, because you are asking the customer to share a financial data set from one entity to the other for a certain longer duration, which as may be required, right? So how do you build trust? What is the customer experience and the journey that you are designing, so that you can get a long-term consent, you build trust, and even though you have these multiple OTPs, how do you control drop-offs? Some of the financial institutions which are smaller in size or have just come in new, we see low success rates. and that still is a challenge. Um, Currently, joint accounts are not supported. So many customers who have joint accounts, especially the people who are 45 plus, 50 plus, they tend to have joint accounts with their family. There we see account aggregator can't be used, and we have to revert back to the original uh, premise of either asking him to upload or to collect a physical copy. And right now, only life and health are the insurance types. We are waiting for group, auto, general also, which can come on board so that we can look at maybe a consolidated insurance analysis or a gap analyzer and so on and so forth. Interesting things that you should consider when you are building your solution is there are other complementary or alternative data sources which are also available. The first being this Insurance Information Bureau. This is more of a B2B source currently. It is not available, so it may not be available to you, but within the insurance community, within the insurance companies, what we do is all um, the people who've applied for insurance in a month, it is all pulled together centrally by a common institute called the Life Council and the Health Council, right? They own this property called IIB, and they keep it as a centralized database where people can check and see, okay, before applying to me, has he applied somewhere else? Is there a possibility of fraud? Has he got rejected from any other company and so on and so forth? So this database is also something that our models use along with account aggregator and the transaction data that comes in. CAMS also has an insurance repository because we have to also now create, it is mandatory to create an insurance policy in DMAT form. And most of these DMATs are created today through CAMS. They also have a centralized insurance repository, so that can also be used. ABHA is another emerging ecosystem, which is your Ayushman Bharat health account. You will get medical data from there. So if you would have remembered the journey that I showed you, one of the ideas was financial underwriting, the other one was health underwriting. So health underwriting can also be looked at from this ABHA account, and that solves your underwriting needs both from a financial and a medical perspective. Um, these are some interesting trends you should keep or read more about and research more about post this call, because these are problems that we are as insurers are currently facing, and we are looking at possible solutions around these areas. So the first one is there is something called as an enhanced surrender guidelines which has come in. It is beneficial for the customer. So let's say earlier, if a customer was paying 100 rupees as a yearly premium, if he discontinued the policy, may stop the policy abruptly before the actual period. Let's say you bought the policy for 10 years. After 5 years, you say, no, yeah, I think markets are doing well. Let's stop this policy. Now you stop it halfway. Earlier, you would get, let's say, 75% of your whatever premiums you've paid, right? So you get only 75% of that. IRDA has revised that higher, so it is closer to 90%. So you get almost all your premiums back, barring all your charges and so on. Now, this is a benefit for the customer, but people are looking at seeing what solutions are there. How can you prevent the customer from surrendering by, you've purchased an insurance for a certain risk that you're covering yourself. Now, suddenly you change your direction because of other externalities. So you should reconsider. So look at this in terms of surrender. What can be done around this? Is there an opportunity also to uh, give more benefit to the customer using surrender value? Like for example, there are loan again policies which are available, and the loan amount is equal to the surrender value. So that might be an opportunity to consider. The second one is this Bima Sugam or the Bima Trinity that the IRDAI or the regulator is pursuing. The idea is to create a neutral digital marketplace for selling insurance, where a customer comes, he has an open choice to purchase from any company that he wants. He gets all quotes at one shot. This is also designed to penetrate rural markets, which is the next trend that we see, that there is major focus from the regulator to start penetrating insurance into the hinterlands. Now, people there have lower incomes, so there might be a need for a smaller micro insurance product. But how can you bring about financial literacy there in the form of maybe expense analyzers, in the form of education, in the form of using account aggregator to create like a a need analysis for all kinds of financial products and also help insurance penetrate there. So these two are interesting trends you should look at. DPDP is another thing that could be disruptive or could help here in the account aggregator framework. The good thing is the account aggregator framework was one of the first to implement a consent-based architecture, which is fairly in line with what the regulation sets. So I don't think there will be trouble, but you can leverage the current consent architecture to look at solutions which also cover the requirements of a DPDP Act. The next trend that comes in is open architecture in agency and bank assurance. So earlier, what would happen is one agent was allowed to sell only one insurer's policy. So let's say I was an agent and I have a tie-up with Max Life, then I can only sell Max Life's policies. I can't sell any other insurer's policies. This is something that the regulator is mulling to change. It has already happened on the bank side, where a bank earlier would be associated only with one life insurer. Today, you can get associated with multiple life insurers and multiple health insurers. That makes it better in terms of from a customer perspective, that I get more choice. The similar thing is going to happen at the agency side. So when you're building solutions for either an agent, keep in mind that this piece might be important. So how do you connect to all different insurers? So you can leverage multiple themes to create or use into your product. There is a focus on straight through. That means we want to try and remove human intervention as far as possible, especially on the issuance side. That means when you're purchasing the policy, and especially on the claim side where you're trying to claim against a policy. So I've already showed you the entire ecosystem there, how we have tried and worked on straight through using account aggregator on the issuance side. On the claim side, we're still working on it, but be useful to see how you can interpret it and move ahead. The other two things, areas of focus is Gen Z. We're seeing a trend that Gen Z likes apps which bring together, which removes the hassles of actually managing pen, paper, Excel sheets, and so on, and gives me ready solutions to manage all my different financial entities at one single place, both purchasing and maintaining and managing everything. So is there something possible here which can also help improve insurance penetration? Similarly, for retirement, with FIRE becoming a buzzword everywhere today, people are looking and are more aware of retirement as a conscious choice very early in life. I explained to you the kind of solutions that we have for retirement. So how do you make that mainstream? How do you create more awareness for retirement, and see that retirement is not just about retiring early. It is about achieving financial freedom and continuing to work with the knowledge that your corpus is safe and is growing at a fairly healthy rate, and you know that market externalities will not have much of an impact on this, right? So these are certain trends that I think will be useful. So that's all I have. I open it up for questions now. So I see a couple of questions.
There are a couple of questions if you can quickly answer that first.
Okay, so I'll take the first one from Ishan. It says here, the insurance company is playing the role of an FIP, and is it responsible for all the checks? The answer is yes. As an FIP, the account aggregator sends, I think, verifies the consent from the customer. That consent is sent to me. I need to check the consent of, that is for what duration the consent has been given. And depending on if everything's okay, then I have to send the data. I have to store that original consent so that when the next pull happens, let's say the customer is given a consent for 5 years. So that's the first time I take the consent. That's it. After that, the FIU keeps pulling the data at the agreed frequency. I just need to check that the consent artifact is valid, and then I can send the data out. So most of this is automated when you are connecting to the account aggregator framework. This is handled anyways by account aggregators. So yes, the onus still lies even on the FIP to verify the consent. The next one is, if I want to recommend the insurance based on users' financial information, how can I recommend any insurance to the user? Where can I get a list of insurance plans available, a central repository for that? Unfortunately, there is no central repository. You'll have to visit each of the insurance company's website, or you can go to Policy Bazaar or any of similar aggregators will have these products. What's important for you to understand is the framework that I gave you at the beginning, that all these products will fit into those three buckets: risk of dying too young, living too long, and growing the money. You need to understand what is the need of the customer and then map the product, right? So if the need of the customer is growing the money, second thing you need to understand, what is his risk appetite. Is he risk averse? Then you sell an endowment. If he's okay to take risk but wants higher returns, then you look at a ULIP kind of a product. If he's looking at building long-term sustained wealth for retirement, then you look at annuity kind of products. If he's only looking at simple term insurance, then use simple term products. It doesn't matter which insurer you take, all the products are very similar. 80 to 90% of the features are same. So focus on the category in terms of recommendations rather than the product or the insurer that is there. I come to the next one. Okay, there are some questions which I've changed. For a salaried person, are we using ITR as data point in AA? Yes, ideally we would like to use ITR. However, ITR right now is not available on our account aggregator. It is still work in progress. But ITR will solve a lot of problems both for self-employed as well as for salaried. If a person's name is different in couple of places, does it create confusion, or could analysts review the data and confirm? So this does create a problem. If the name is different from the KYC, right, then it's a problem, because then I need to do manual scrutiny. I had to ensure that, okay, this is the same person. I look at couple of other sources. But let's say I take two bank accounts. I look at his mutual funds also. I look at some other financial entities data that I've got, and I look at KYC. Then a manual underwriter can take a call saying that, hey, this is the same person. Then maybe there's just one word which is different, and so on, and might take a judgmental call. But yeah, it does create confusion today if the names are different. Is there securitization equivalent for insurance policies like there is for loans? If I understand the question correctly, are you asking me, is it available on DMAT form? Yes. If you are asking me, is there a loan against a asset which is possible? Yes, both are correct, possible. So the insurance policy is available today on DigiLocker by default. It is also available on a DMAT account, and you can use it to get a loan against this kind of a policy, depending on the type of policy. If it is an endowment policy, the higher will be the loan amount. If it is a ULIP policy, predominantly lenders don't offer it because, again, market linked. It is treated as risky as mutual funds, right? Retirement is still okay, depending on what kind of product.
And Colin, is there any availability of a lien marking API in insurance space? Like, how do the lender get to know that this insurance has been, the customer has already taken a loan on this insurance or not?
In account aggregator, one of the fields is there which tells you whether it is lien marked. So you can check whether the policy is already lien somewhere else.
But is
That
it
is available.
so in security market, we have NSDL and CDSL who offer a lien marking API. So on a real time, I can lien mark any
So in
policy.
in account aggregator, when you pull data from us as an FIP, one of the fields is whether the policy is
Correct.
lien marked.
And this can be used to know that which policy is being lien marked or on which
Correct.
customer has taken the loan.
Correct.
But not from, I'm just talking apart from AA
If I
space.
have to put a lien on it
Correct.
right now,
Hmm.
not all insurers have it. Some of them do have built
But Max
this.
have it, and these the
Max
bilateral
is
connections?
work in progress. This
Okay.
might be available because this might be available maybe once ONDC is live, as a use case. The problem is, it is as an insurer, I'm not too comfortable putting a lien on the product, because I told you I need to ensure that my uh, premiums come in. I have made certain calculations because of long-term premiums. So there is, unlike FDs, which are 5 years, 10 years, we have 10 years, 20, 40-year policies. If they get lien marked and get surrendered, it's a huge hit. So that is why people are a little skeptical. But we see that coming in very soon.
But isn't it both ways? If you are giving that opportunity for customers to take loan,
Hmm.
there are chances your surrender which is happening because customer is in crisis or need money. get reduced.
Yeah,
What do you think?
but see, unlike the lending or unlike FDs, in insurance, the as part of my policy design, I myself am allowed to to give a loan to the customer. I don't need a lender to do it. So I mark the lien to myself and I give the loan. So that is also possible. You can take a loan from an insurance company. So if you go to Max Life and you have a Max Life policy and you say I need urgent money right now, so I will tell you don't break it. I'll give you a loan. Usually traditional policies which are endowment do have the feature of a loan already inbuilt.
And
You can
that is
take the
given
loan.
by Max, by the
It is
insurance.
given by Max Life. Yes, it's given by Max Life itself. Uh, okay, I'll go to the next one. I may have missed this, but could you speak about reinsurance markets and how AAs could help? Uh, See, reinsurer is basically a B2B arrangement right now with an insurer. So we haven't seen too many use cases there. But what we do is whatever we do in terms of financial underwriting can directly flow into the reinsurer for their checks. Many reinsurers also have their digital underwriting uh, softwares which many insurers end up using. So A data can be an input to that. And instead of the insurer taking a decision, the reinsurer's engine can take the decision. These reinsurer engines, which are present at reinsurer underwriting engines, which are present at insurers, are usually a black box for us insurers. We don't know what are the metrics that go into taking a decision, but I can just directly give the data feed and it can help in STP. So that is one of the things that is possible that I could think of. There might be more, but I may not have much knowledge on that part.
So, Colin, actually, we have another masterclass. The speaker is waiting. So, we'll take one more question. And is it possible for you to join the group? Like, we have created a WhatsApp group on SMEs where
Yeah,
maybe,
I think I'm already a part of it.
okay, great.
Yeah, so you
Then
can
maybe we
ask me
can
questions
pose
there.
these questions there and people, you can answer those. Right?
Okay, so I'll just go quickly. Ajit's question: if I participate in AI, I allow the user to create a self-user contribution. Any data that comes in through an AA, if you are a regulated financial entity which can use the data, you can do analysis. If you are an intermediary like a TSP, you can still do this as long as you have the right agreement with the FIU to do the analysis for them.
So Ajit question is, I'll elaborate on this, Colin. So right now, all AAs don't have access or disable the self-download data feature from their app.
Hmm.
There are some guardrails we are working on. Once it is there, we can it will again get opened up.
Okay.
So right now, it is not there from a self-consent point of view.
Acha. So, okay, from the AA portal.
From there, so he's
Okay,
saying you
understood.
can download it and then you can it
Okay,
be
Viraj has said drop the link to Max Live. You can go to the website and look at any term policy. You will see the account aggregator journey built into the term policy.
sent.
Surrender benefits. Can we create a verifiable credit? Uh,
I think the question is not very clear to
yeah,
me.
but I think the question again here is more on loan. Can I take my policy, give the policy to somebody else, and take a loan against the policy? Yes, it depends on the lender. Insurance company will give you a loan if it is a endowment plan, that is a traditional plan. For any other type of products, term, ULIPs, ULIPs usually insurance companies try and avoid, but lenders do give. So you can check with the lender. There are lenders who do give loans against ULIP products also, but that will be like 30-40% of the corpus amount. I think that's it. I don't see
Yeah.
any
So
other
there are some
questions.
in chat. Ashish and all, we can surely answer it in the groups. Please post your queries if it is unanswered in the group. We'll happy to answer there. Thank you, Colin. It was really a nice presentation. A lot of things which I myself got to know. We'll take your expert advice also till the hackathon period starts, and if required, we can have some other session also, a small group interaction with the people who are building into this space. Thank you.
Sure,
Thank
sure.
you
Thank you so
everyone for
much. Thank
joining.
you and wish you all the best.
Thank you, Colin. And we have Aniket has posted a link for another masterclass. Request you all to join there. It is on investment advisory. Thank you. Thank you all. Good evening. Good night.
Thank you. Thank you.